Given the week we've had in the Treasury market, would you guess the equity market was up on the week? Positive, and positive again this morning. Futures up 0.1%. Good morning to you all. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
From New York, we begin with the big issue, some big forecasts.
This is the scenario that I think the Fed was concerned about.
This was exactly what you did not want to see.
Inflation at 7.5%.
What's the Fed going to do from here?
Whether inflation's 7.3 or 7.5%, I mean, they're going to go and they're going to go hard.
All options are on the table.
On top of that, there's a lot of political pressure.
The big debate is, are they going to do it in measured 25 basis point increments? Or
start off with a 50 basis point hike.
I would like them to just get on with it. Let's do 50.
50 basis points is definitely on the card.
It seems very likely that the Fed's going to go 50 in March.
We'll be watching for how Fed officials talk about 50.
The calls are pouring in, and I'm pleased to say we start this morning's programme with Mohamed El-Erian of Bloomberg Opinion and Queen's College, Cambridge. Mohamed, I've seen 50 from Deutsche Bank, 50 from Citi, 50 from HSBC. I can't keep up. Let's start with the data, then we'll turn to the Fed. Is there enough information in a 10 basis point beat on core CPI to come up with these calls?
I think there is enough information to say the Fed is way behind, because it's not just the beat. It is also the dynamics underlying the beat. It is also what happened to core CPI, and it's also about inflation still in the pipeline. So I understand this, but I'm sort of astonished that most of the people that you featured and that are my friends have gone from camp transitory to somewhere which is not just 50 basis points. Some people are calling for 75 basis points. Some people are calling for an emergency rate hike. Some people are calling for $2 trillion of balance sheet reduction. The Fed has lost control not just of the inflation narrative. It has completely lost control of the policy narrative. And that's an issue of real concern if you care about the economy.
Well, how can they correct that course, Mohamed?
It's very hard, John. You know the story of someone asking someone else, how do I get to a certain place? And you say, you don't start from here. There is no easy way to fix it. They had many opportunities to avoid this situation. They were warned by many. Now they're in it. I don't have a right answer for them. I can tell them, here's the risk of various approaches, but I don't think there's a first best approach at this end. We are deep in the world of second, third, and fourth best.
Mohamed, we've got a ton of rate hike calls I want to work through with you. 50 basis points from, say, Nomura. They were out early, to Citi, to the likes of, who else we got? Deutsche Bank, HSBC. I'm losing count. This came from Goldman. They're looking for 7 hikes, consecutive 7 hikes, 25 basis points each through the rest of 22. Then they say we go to a gradual pace of once per quarter. That pace into 23, Q1 to Q3. I just wonder for you, Mohamed, it's been interesting for me to watch all these calls come in, and they're front-loading rate hike calls, say 5 or 7 all at once, meeting after meeting. But the terminal rate's not changed. The destination hasn't changed for these people. Has it changed for you?
So, John, first understand what people are trying to do. They're telling the Fed, move aggressively now, because if you move aggressively now, you have a chance of regaining policy credibility, and then you don't have to move aggressively later. That's the implicit bet in people saying 50, 75, let's have an emergency rate hike. That is what they're basically saying. It's not that straightforward, because there is an equal chance that by moving quickly now and aggressively now, the market prices in aggressive moves again and again and again. This is what typically happens in a developing country when a central bank loses control of the policy narrative. So this is a really tricky judgment call that the Fed is going to have to make. And I'm not sure that the right answer is there. Look, I've been on your show for almost a year now, warning that we have to take inflation seriously, warning that the Fed should move early. It is absurd that we're still injecting liquidity at this point. into the economy, but we are. At this point, I find myself really worried that if they do hike by 7, which is becoming the consensus call, they may break something in the economy. And yes, inflation will come down, but it will come down for the wrong reason. That's why, I wouldn't back a 7 hike cycle this year alone. I'd be really worried about the economy.
Well, Mohamed, you said the window is closing to engineer a soft landing. Is it shut now?
It's pretty closed. And what hasn't been covered, and I'm glad to see that there's a bit less anxiety, is the way the fixed income markets traded yesterday. Seeing these massive moves in 2 years is one thing, but also hearing that there were patches of illiquidity, that market functioning wasn't where you want to be. You're talking about the most important market in the world. And what we saw yesterday, I can tell you, was not comforting by any stretch of the imagination.
And Mike McKee, I'm sure it was pretty uncomfortable for this Federal Reserve as well. Mike, there are some people thinking about a move before March 16th, a move before that scheduled meeting. Mike, I caught up with Mark Urbano of Bank of America this morning. He said, look out for 3 p.m. Andrew Hollenhorst of Citi said the same thing. Look out for 3 p.m. because Mike McKee, at 3 p.m., the New York Fed puts out its bond purchase schedule for the following month. Do you think 3 p.m. is one to watch?
Not really. I think it's going to happen. If the Fed did not make an announcement, it would be taken as a sign of panic at the Fed, and the dislocations that we saw in the market yesterday would happen all over again, and they don't want that. And there's really no advantage to them to pulling back, even though I see Mohamed's point. At this point, the amount is so small, it really isn't going to make a difference. So I would look through that, and I would also look through what Jim Bullard said. Was Jim Bullard leading the markets, or was he reflecting market desires at this point? Here's what he didn't say. He didn't say they will raise rates 50 basis points in March. He said at some point they should raise rates 50 basis points, but he would defer to the chairman on when. And he did not say we should have an intermeeting move. He said we should talk about it if it's necessary. But the market ran with the opposite interpretations of both of those until we started calling around, as did others, to other senior Fed officials, and we got some real pushback to the Bullard ideas. Mary Daly telling Market News a 50 basis point move is not my preference. I don't see us as being behind the curve. Tom Barkin last night in a speech saying, do I think there's a screaming need to do it right now? I'd have to be convinced of that. So it doesn't look like the Fed is on board with a particular plan to do anything, not 7, not an emergency, not 50 at this point. And look at this chart here. This is what's happened to the yield curve over the last month as the market has priced in what it thinks the Fed is going to do. The Fed doesn't have to do anything at this point because a 2-year yield is basically 6 Fed moves higher right now. Now, they could move and do a 50 in March and just sort of walk through the open door there, but it doesn't look like they need to change their policy or announce a policy immediately because they've still got time before that meeting, and the market's doing their work for them.
And Mike McKee, thank you, sir. Thank you very much. We need to talk about balance sheet reduction here, Mohamed. The optics of this, I think it's fair to say, are pretty embarrassing. On the screen right now, I don't know if you can see it, Mohamed, but it's the balance sheet over the Fed. It's still climbing. We're doing QE with inflation at 7.5%. Now, I don't know whether you think they will turn around at 3 p.m. Eastern later this afternoon and say, you know what, we're just going to stop QE now. Do you think they should?
I don't, and I don't think they should do an inter-meeting hike, not because I don't think they are way behind on policy. They are so far behind, John. I don't remember a central bank being so far behind. You know, I warned that this was going to be one of the biggest policy errors. It certainly was one of the biggest inflation miscalls in the history of the Fed. And unfortunately, my nightmare is playing out. I wouldn't do a inter-meeting. I wouldn't not announce the balance sheet. I wouldn't stop QE suddenly. They should have done that much early. If they do it now, the market will sense blood. They will sense that the Fed is panicking. The Fed has to do 3 things really quickly. It has to regain control of the inflation narrative. They have to be very straightforward, explain to us why they were so wrong and why we can now believe their inflation forecast. 2, they have to regain control of the policy narrative. They have to give us some sort of sense of what the soft landing looks like. And then 3, importantly, they also have to show a lot more humility. Part of the problem that the Fed had is it got itself held hostage by views it took earlier. Look, this stuff is doable. It's really hard at this point, but it's doable. But the leadership has been completely silent. We haven't heard from anybody that's viewed as mattering on the FOMC.
Mohamed, just a final question for you. We've got market pricing in one place and the Federal Reserve clearly in another. 0% on rates, still doing QE, a market that's looking for a lot of rate hikes now through this year. And you heard Mark Cabana of Bank of America earlier this morning on Bloomberg Surveillance talking up some monster balance sheet reduction as well. RBC said this: the current pricing is close enough to the hawkish extremes of likely outcomes that the risk-reward of fading it is too attractive to pass up. Now, Mohamed, these are two different conversations. What the Fed should do, 1, what the market is priced for, 2. Are you prepared to say that given where market pricing is right now, we've reached peak hawkishness?
No, I'm not prepared to say that yet because the outlook is so uncertain. We have a huge range of outcomes. What I am prepared to say is that if the Fed ends up hiking 7 times this year, and if it ends up starting with a 50 basis point hike, yes, inflation is going to come down, but it's going to come down at a massive cost to livelihoods, to the economy, to everything else. So it's going to be a very delicate balance. This is important not just for the bond market, it's also important for the equity market. The equity market is still comfortable based on 2 things: earnings, which have been strong, and the behavioral condition. The earnings become in play if ever the Fed overdoes it and we end up in an unnecessary slowdown, which I am concerned about, John. That's the policy error. Having gone too slow, that then forced by the market to go too fast, and the economy got sacrificed. And
Mohamed,
that would be tragic if that were to happen.
We've got to go. Fantastic as always, sir. And as always, thank you for being with us. Mohamed El-Erian of Bloomberg Opinion. He's been warning about this for at least 9 months. Get ahead of it. The Fed needs to stop doing QE, start slowing it down. And here we are, 7.5% CPI, 0 rates, and a Fed still buying bonds. Equity futures up 0.1% with your movers. Here's Abby.
John, well, we do still have lots of earnings reports streaming in. One of them, Zillow, shares are popping sharply higher. This after the online real estate company put up a very strong quarter. They beat revenue estimates by 31% as they paired the inventory of homes from the since-closed Zillow offers. Higher prices cut the loss there by about 20%. Now, there is a 16% bearish short interest on this stock, so this could be somewhat of a squeeze. A big one, Under Armour. They put up a massive beat, but warning over the supply chain. So even as they topped revenues by more than 9%, that supply chain constraint that we've been hearing from some companies hitting the shares of Under Armour. They are also cutting their spring-summer order book on those shortages. And then finally, Affirm Holdings plunging down about 9%. This is Amazon Payments partner. Their third quarter revenues forecast missed estimates. They're seeing higher charge-offs on loans. And John, this is something that happens typically as rates rise. So perhaps there could be more of an issue here going forward, and that's why the stock is down so much, John.
Abby, thank you. Thank you very much. Coming up, Capitol Hill turning up the pressure on the president to tamp down inflation.
Inflation and soaring prices are crushing the American people.
That conversation up next.
The data confirm what working families already know painfully well. Rampant inflation and soaring prices are crushing the American people.
That's the Republican view. A red-hot inflation print increasing pressure on the Democrats. The White House continuing to push its economic agenda to cool the temperature.
We certainly have lots of countervailing pressures going on, driving price growth. We have a very active agenda, both near, medium, and long term, to try to ease price pressures. It involves our work at the ports, our work with trucks, our work with competition, our work on energy, longer term, getting domestic chip production up and running. An active agenda that we have to keep pushing on until these hot prints begin to cool.
Let's get down to AMH down in D.C. Morning, Anne-Marie.
Good morning, John. Well, Mohamed was worrying about inflation, as you say, about 9 months ago. This administration was saying it was temporary alongside the Fed. And the president in December said that was the peak. And then we had a 7 and a 7.5% inflation handle. And now they realize this is going to be a massive headache politically. Yesterday, the president was talking about potentially one aspect to lowering inflation and the cost for consumers, and that was in prescription drugs. But even then, he said he understands why inflation is so hot. It is hurting American families because he grew up in a household where the price of gasoline took away from the money that his family could spend. He said he's going to work like a devil to try to bring those gasoline prices down. And then on Capitol Hill, Jonathan, you have senators who are reiterating what the president wants to say about prescription drugs, but also acknowledging, like Senator Bernie Sanders, acknowledging that this is going to be a political headache. A recent Economist YouGov poll, Jonathan, says 84% of Americans think inflation is a very or somewhat serious problem.
AMH in Washington. Anne-Marie, thank you. We get consumer confidence numbers at 10 a.m. Eastern Time. In about 40 minutes, Guy Johnson and the team will break that down for you. With us now, BlackRock's Boivin, Morgan Stanley's Dan Skelly, Katy Kaminski of AlphaSimplex. Katy, let's come to you first. What did that inflation print change for you, if anything at all?
It didn't change the narrative for us, but I think what it did for us is confirm the signals that we've been seeing. We're seeing some of the strongest short signals in bonds that we've seen in decades. And we had 2 stops and starts last year. And yesterday really felt like the nail in the coffin, that this is the 3rd time we're really going to see rate hikes for the first time, and that this is a serious problem that we have to deal with.
Boivin, you expect an active Fed. You question what it will achieve. John, can we sit on that? I think the point you're trying to make is one not many people are making. You are questioning what it can achieve and questioning whether it will have any effect whatsoever in bringing down inflation. John White.
Yeah, first of all, thanks, John. Good to see you. I think, first of all, it's not a Volcker moment. I think the narrative is getting completely out of hand here. I don't typically want to side and try to defend Fed officials or central banks, but like the Fed bashing is getting to a level that I think is a bit also out of control. The reality is this inflation. I mean, we saw that coming as well for a year or so. It's a restart. It's a very unusual phenomenon that we've never gone through before. Applying the playbook from previous cycles, but framing around beyond the curve on inflation, so on, we think is doesn't really apply here. And this is not an inflation that the Fed can do anything about at this stage. Wants to control inflation down the road, but not the one we're seeing here. And as a result, a strong case to normalize policy at this stage and to raise rates. So no doubt about this. But that's very different from slamming the brake. And all of that gets confused at this stage. And that's why we think things are getting a bit out of hand in terms of hawkish expectations.
Dan Skelly, you've had a view, a framework of thinking about this. Fire and ice. I want to talk about the ice part of this because this seems to be the dominant factor for you. The risk is we go from inflation scare to rate response to growth scare. Are you on that topic right now, the 3rd point, Dan? Is that what's driving you?
Hey, Jonathan, thanks for having me. I think we're getting there, and markets have struggled to make new highs really since post-Thanksgiving when transitory was officially retired. So, look, the market fully gets now the inflation scare. That's, we think, getting closer to in the price. The question for markets going from here really has to do with if the Fed put has been removed from monetary policy, what happens to the consumer and the corporate balance sheet put, right? So we know consumers and corporates are flush with cash. We think earnings are clearly going to slow down from last year. And we think the consumer ex fiscal spending is going to be in a little bit more of a difficult spot. The offset to that is high-end consumers. When you think about how the job losses were concentrated in the low end, and when you think about the flush portfolio gains and house price appreciation, that's completely buffering the high end. So that should be an offsetting factor.
Katy, you think the bond bull market is done? My question to you from an equity perspective would be, can we get some relative returns, even absolute returns in an equity market if you believe that the bond bull market is done?
Well, this is where it's going to be interesting because it's going to depend on how the Fed actually reacts and if they act too aggressively or if they don't act enough. there's going to be some challenges to growth, potential for slowdown. And if inflation is hotter than we would like, you can already see the pressure that's building in Washington. You can see the pressure that's building on the Fed. You can see the narrative. So it's really sort of a rock and a hard place right now. So as long as we can kind of smooth through this environment and do something and see this abate eventually, I think equities have some legs to stand on, but I'm a little bit nervous of the fact that we haven't yet to even have one rate hike, and we're still very nervous about just the potential of that. So I think it isn't an easy situation for the equity market this year.
The more we wait, apparently, the higher the number gets. Dan Skelly, Katy, Kaminski, Jean Boivin will be sticking with us. If you want a different view on things, Barclays go to 5. They go to 5 hikes and they say this: we expect a deceleration in inflationary pressures to open the door for a more gradual pace. And just on the destination here, when you hear all these calls about 5 hikes, 6 hikes, 7 hikes, ask these people about what their terminal rate is, what the end destination of the rate hiking cycle is, because some people haven't changed that view. Barclays still see it at 175 to 2. And if you're an equity investor at the moment, would you take 175 to 2? If I could guarantee you that, is that enough to make you feel comfortable? We'll discuss that in just a moment. Coming up in the morning calls and later, Under Armour, just one more company amongst many companies falling victim to supply chain constraints. That conversation just around the corner. That stock down by 2.8%. Equity futures recover through the morning as Treasury yields back away from yesterday's highs. We're down 3 basis points on 2s to 155. We're down 3 on 10s to about 2%. This is Bloomberg. So year to date, we've had about an 80 basis point move on a 2-year yield. This week, a monster move yesterday, the biggest move on a 2-year going back to 2009, up about 20 basis points. The equity market is up 0.1% on a week. Really resilient considering. Futures unchanged on the S&P, recovering on the Nasdaq too as yields back away from session highs. That's the price action. Here are your morning calls. First up, JP Morgan downgrading Kellogg's to underweight, highlighting its unfavorable stretched valuation and overly aggressive profit outlook. The stock is up by 2.5%. Your second call from Mizuho, upgrading Murphy Oil to a buy, $42 price target. The analyst expecting a pickup in production with visibility and cash flow improving. And finally, Bank of America upgrading Block to a buy. The analyst seeing an attractive setup heading into earnings following the stock's notable sell-off. That stock is up 2.5%. Coming up, Under Armour becoming the latest victim of supply constraints and rising prices. Your opening bow to close out a crazy week is up next. "24 seconds away from the opening bell in New York City this morning. Good morning. What a week we've seen in the bond market. Not so much in equities. Equity futures are just about positive on the S&P on the week, on the S&P 500 into Friday. Just about positive too, up 0.1%. That's the opening bell. Switch out the board and get to the bond market. On the week, your 10-year yield up around 9 basis points, down 3 this morning, just sub 2%. Just on 2s, up more than 20. And we did much of that in one session alone, off the back of CPI and some Fed speak from the St. Louis Fed President Jim Bullard in the exclusive interview here at Bloomberg, talking up the prospect of maybe 50 basis points in March and perhaps 1% by the time we get to the summer on a Fed funds rate. Euro dollar south to 114, 113.89, down 1/3%. Crude into the 90s, had a little look at 91 earlier, 90.95 right now, positive a little more than 1%. At the opening bow then, here's a state of play with 30 seconds in. We advance 0.1%, a marginal move higher. Feels like a big move compared to where we were on futures a little bit earlier this morning. Top of the pile, energy up 0.5%. Bottom of the pile, the financials down 1/3%. We'll get to the banks in about 5 minutes' time. The materials down by 0.6%. Anastasia Amoroso of iCapital said this: it's been such an unforgiving macro environment that unless you deliver top-of-the-line beats and upgrades, you're not going to get rewarded. Taylor Riggs all over earnings season. Taylor, at times it's been tough.
Yeah, indeed, John. And what's so interesting is I know after the big CPI print report yesterday, we've really been focused on the consumer and the ability for these companies to pass on those costs to consumer. But actually, in the last 2 years, it's those producer prices that have actually risen a lot more. If you think sort of the input of the raw materials, those are up 10.6%. Now, of course, consumer prices are still up 9.4%. But this just puts into perspective sort of that broad-based inflationary pressures that pretty much everyone is experiencing at this time. Let's speak, though, to the quote that you just mentioned at the top of the segment, because when we take a look at earnings season, fourth quarter earnings beats by segment, for example, industrials actually did better. They had bigger earnings growth than they had the sales growth. So margins there are healthier. But you're seeing fewer earnings beats on, let's say, staples and discretionary. And that's showing that there is a little bit of that margin compression and maybe taking more time to pass on those costs to consumers. I know we spoke about Chipotle earlier this week. We could go on and on about that. I will spare you. But what I will say is that at least with some of the companies that, let's say, have really strong brands, right, or are able to pass those on costs to the consumer, they're actually doing a pretty good job. You think Chipotle, you think Harley-Davidson, you think Peloton. And that's in a big contrast, John, to the companies like Clorox that we saw also earlier this week, saying it's going to take us a few years to really sort of boost up those margins back to some of the earlier levels that we've seen.
And what is it you want from Chipotle, just to give you the opportunity?
Cauliflower rice.
Okay, thank you. I feel like that's a fee just for your appearance, just to rant on about cauliflower rice. Thank you very much, Taylor. Looking forward to the close a little bit later with Romain and Caroline as well. Tons of earnings, all about retail next week. Under Armour out, getting ahead of the crowd, topping analyst estimates, but raising concerns over, guess what, quote, material impacts from supply chain constraints. Abby has more. Hey, Abby.
Hey, John. Well, a brutal decline there for Under Armour right now at the lows in the pre-market, down just about 2%. And the funny thing is they put up a great fourth quarter, similar to some other companies, big volume, beating profit estimates, beating sales estimates, but it's all about the future. And yes, they are talking up supply constraints. Now, one thing to remember for this company is a lot of their apparel comes from Southeast Asia. So the supply constraints there, the way to fix it, air freight. That is very costly, and that is really weighing on the company for sure. Now, relative to companies reporting next week, Walmart is really the big one on Thursday. We'll get a read on big box retailers and the health of what's going on for those companies relative to the supply chain. Something we already know about some of the consumer staple margins, they're already seen being squeezed. So the question is, how bad will it be? For the fourth quarter, it's expected to be 8.9% overall for the consumer staples space, down from almost 11%, and then perhaps rising a little bit in the second quarter. But if the big box retailers give a similar story to Under Armour and some other companies, it could be kind of ugly. This could be why a lot of these stocks are down more than 5% this year, John.
Abby, one of the headwinds from last year. We've got to think about it again, all over again this year too. BNP cut their price target on the S&P down to 4,900. They say this: higher rates, particularly higher real rates, are a potential headwind for equities. We're acutely aware, based on the Q4 2018 episode, that when central bank tightening coincides with earnings expectations falling, the market can sharply correct lower. Dan Skelly, does that resonate with you? I think it does.
It does, Jonathan. And look, we were calling for a little bit of a trickier market this year. Mike Wilson's call was for 4,400 to start the year. So that's a tad lower than we are today. Let's keep in mind, Jonathan, a lot has been discounted already, right? So if you think about the average stock in the S&P 500 is down 15% off the highs. The average name in NASDAQ down 24% off its highs. The average Russell 2000 small cap is off close to 35% off its highs. So a lot has been discounted already. We do see slower earnings growth this year. It's going to be a year for much more opportunity and active bottom-up stock picking.
John, you're still overweight equities, and I just wonder what's bringing you comfort right now, given what I've just heard from Dan Skelly?
We're still modestly overweight equities. We've dialed down, the overweight coming into the year because of the greater, I guess, Fed uncertainty or central bank uncertainty we were seeing, confusion being one of our key theme. I think the main headwind, in fact, going forward for us is not so much rates going up. I think they're going up, but I don't think we're going to see delivered the kind of hikes, the 7 hikes for this year. We don't see that in the cards. So ultimately, we're going to see a more muted path. So that's not really the headwind, but the confusion is real. And there's a Fed premium that needs to be now compensated. And that's really more where the headwind is coming from. So we still think ultimately, it's going to be a more supportive environment than is currently anticipated. And so we're still overweight, but it's a bumpier, much bumpier.
Can margins hold up? Katy Kaminski, I want to bring you this quote from Clorox and a CFO. Said this is the fourth inflationary cycle we've gone through in the last 10 years. Historically, it's taken us about 12 to 18 months to offset cost inflation and rebuild margins. I would tell you, though, in this case, because of the extreme level of inflation we're dealing with, I expect it to take longer. I do think it's going to take several years for us to rebuild margins. Now, of course, this is a very separate company from, say, consumer discretionary. This is a staple-like company. So I want to come to you, Katy, and ask you about margins. And I wonder whether we can make some broad-based assumption on what's going to happen, say, at the index level of the S&P, or whether we've got some concentrated consumer price tolerance that some companies, some sectors can take advantage of still.
I think that's a good question, because for us, the way we see it is more sort of as a pipeline issue. You start off with raw materials, and all of these things have to trickle down through and see which companies can actually pass these through or not. And from our side, one of the challenges, the key inputs, which are those raw materials, are still faced with this mismatch where at 7% inflation and 2% 10-year, we have an implied negative rate, which means that commodity prices and inputs are still going to remain challenged until we can alleviate those issues. On the other hand, for margins, you are seeing some companies, other companies, being able to actually pass some of those through. So I think it's going to be the same story this year. Watch those commodity prices, see if we can find a way to abate them with some policy response. And secondly, see which companies are actually able to navigate some of these, challenges to margin in general.
Dan Skelly, what I think will be interesting when you and I catch up, Mike Wilson too, is that increasingly as the year progresses, there's a feeling that we de-emphasize the year-end index targets and we start talking about single names with you, Dan, in a much, much bigger way. Can you give me a flavor of that now, Dan?
You're already starting to see that play out in the last 4 or 5 weeks of earnings season, Jonathan. Even among the big mega cap FANG names, there were tremendous swings among the names that were the winners, the names that were the losers. And so, look, what I would say is, broadly speaking, we agree. We do think there's going to be more dispersion, more opportunity to decipher winners from losers. In terms of sectors, at that perspective, we still like sticking with energy, given that inflation offset, given geopolitics, we all know too well in the near term. We like healthcare as an area of earnings stability, some decent dividend yields in that space amid a higher volatility market. And we think that's growth and innovation that's reasonably priced. Now, look, the last thing I would say is technology, and amid the software and growth space, that sector has seen tremendous volatility the last several weeks. What we would say there is don't bottom fish in terms of the speculative names that are reliant on funding and have balance sheet issues. Focus on the high free cash flow, quality names that are taking share in what will continue to be a digital transformation economy post-COVID.
Jean, one winning sector over the last few weeks, particularly the last month, year to date, has been the banks. It's picked up in the US more recently. In Europe, we're up 13% on the Stock 600 banking sector. Bank of America came out with this morning, Jean. I'd love your input on it. We lower European banks and value versus growth stocks from overweight to market weight. After more than 50% outperformance since late 2020, EU banks are already priced for the modest further upside for the US 10-year bond yield that we expect. Jean, just on the financials, a lot of people have gone there, sat there, almost wanted that exposure as we expect higher interest rates in the Treasury market, in bonds, at the policy rate, the ECB, the Federal Reserve. Is that overdone now for you, Jean?
Well, I would stress that the backdrop favorable for financials having to do with what we think the yield curve is going to do over the next few months and years, I think is constructive. We've seen some flattening of the curve over the last few days, despite the fact that long-term rates have been increasing pretty materially. I think there's a bit of a policy mistake being priced in. As I said from the beginning, we don't think that's going to happen in the end. I think we're like in the middle of confusion right now. This narrative will get clarified hopefully over the next few meetings. And once that's the case, then I think we're seeing like a gradual steepening of the curve that should be supportive of that sector.
Katy, your views on that yield curve? Bank of America and Mark Cabana this morning came up with some really big numbers. 7 hikes this year, $1 trillion of balance sheet reduction this year, next year too, and potentially an inverted yield curve. Is that your base case now too, Katy, going into year end? Or are you a little bit more constructive on maybe getting some steepness back in this curve?
I have to admit we're relatively bearish, and we're actually seeing some very strong signals that yields are moving that direction. Since we follow market prices, it's been fascinating to see how strong the moves have been. So for us, yesterday was basically just a confirmation. So from our side, we see that this problem is going to have to be alleviated and that yields are going to have to go up. And from a historical perspective, we're also seeing that these signals are, from a technical perspective, very consistent with what would be a rising rate environment going forward. So I think that for us is a pretty strong view, especially in the short term.
Typically things turn out okay, more often than not. Dan Skelly, whenever we have scares like this and the market gets jittery, things turn out okay. Even after Q4 2018, things turned out okay in 2019. Even after spring 2020, this equity market, things turned out okay. That's what I want to finish on the RBC quote that I read out a little bit earlier on with Mohamed, and read it again. The current pricing is close enough to the hawkish extremes of likely outcomes that the risk-reward of fading it is too attractive to pass up. Now, Dan, my question would be, where would you fade it? Now, I know what your base case is, but if I could guarantee you that this Fed can engineer a soft landing, that we get back to a sustainable level of growth, that inflation comes down in a material way, and we all feel nice about the economy again, what would you be buying today?
I think you want to be buying some of the tech areas that have cyclicality attached to them, i.e. semiconductors. Some of those areas that are going to, once the market stops thinking we're going to have this policy mistake, or even thinks that we're going to have an inverted curve and a potential economic recession, I think what's going to be in favor again then will be the tech names with cyclicality. So I think semis would be an interesting idea in that particular theme.
Dan Skelly. Jean Boivin, what about you?
I think I would not dismiss that the macro call here. I mean, I think you're right. Like it's maybe a bit more dispersion we're going to see and so on. But like the main driver is an inflation story. I think this is going to play out at the broad market level. I think during the course of the year, and I think we've talked about peak hawkishness. I think for me the frame is we're at peak confusion at this stage. And I think we're going to see more clarity over the next few months, and I think that's what needs to be tracked.
And that's one thing we could all agree on. Katy Kaminski, same question. Final word to you.
I think my view is more that if you look at interest rates, higher rates aren't going to be a problem eventually. We just got to get there. And so from that perspective, longer term, I do feel like equity markets and the economy will stabilize through this movement, but it's just going to take a time to get to that point. And so I'm just hopeful that we can do this in a way that's smooth, and that equity markets will be able to take the change in rates, and some of these issues will dissipate from supply chain issues.
Well, they've taken it well this week. The S&P basically up 1/10% on the week so far, even with this rate hike conversation. The S&P at around 4,500. Katy Kaminski, thank you, alongside Dan Skelly and Jean Boivin. To the three of you, thank you very much. What a week it's been. What a couple of days we've had. A 24-hour period where the two-year yield has just absolutely surged. 15 minutes in, coming up, the Biden administration continues to pledge its unwavering support for Ukraine.
What we're committed to in the case of Ukraine is doing everything we can to defend Ukraine's territorial integrity, its sovereignty, its independence, which unfortunately is being challenged right now by Russia.
The update from Washington, up next.
American citizens should leave now. We're dealing with one of the largest armies in the world. This is a very different situation, and things could go crazy quickly. There's not. That's a world war. When Americans and Russians start shooting at one another, we're in a very different world than we've ever been in.
President Biden urging Americans to leave Ukraine. The NATO chief Jens Stoltenberg warning of potential conflict, saying the following: there's a risk for a fully fledged invasion, but there's also a risk for other types of aggressive actions, including attempts to topple the government in Kiev, hybrid cyber attacks and many other types of Russian aggression. Russia continues to deny any plans to invade Ukraine. Joining us down in D.C. is Bloomberg's Anne-Marie. Anne-Marie, an important call coming up a little bit later this morning.
Yeah, just got confirmation from the White House. We heard it earlier from the Canadian Prime Minister's office. President Biden is going to be talking with the leaders of a number of European countries like Germany, Italy, Poland, the United Kingdom, NATO heads. And this is in regards to what the next steps are when it comes to the tensions regarding Russia and Ukraine. We don't know yet, Jonathan, what the next steps are on the diplomatic path. We've had a flurry of meetings happen, but really nothing concrete has come out of them. We did hear from Antony Blinken, the Secretary of State, as he wrapped up those Quad meetings in Australia. And he's saying we're now in this window where we could see a Russian invasion. Although, Jonathan, as you said, we should note, Russia still denies that they intend to do that.
AMH, the president trying to get a lot done this week. Also a conversation with King Salman in Riyadh in Saudi Arabia to do something about what's happening with energy. Can you just tie everything together for us on the week we've had so far?
Well, when it comes to energy, Jonathan, the administration's at a very interesting moment. You have a few things happening. One, tensions with Russia are going to increase the premium on oil prices. Two, you have this outreach to the king. We should note it's to the king. The administration is still trying to figure out what that recalibration with Saudi Arabia is going to be, because they maintain that it will be counterpart to counterpart, not engage with Mohammed bin Salman, who is the individual that is responsible. At the same time, there are talks of a potential Iranian nuclear agreement, and they are coming up to a point at the end of February where they said they would need to see action on that. I don't think the Saudis are going to move on any more barrels in the market until they know and they have clarity on if there's going to be a resurgence of Iranian exports. So it's a very interesting time where the geopolitics is also having a risk premium into what we are seeing in the financial market.
It's a serious, serious issue. And AMH, let's just sit on it for one further question and response if we can. I think we've got to emphasize how complex these issues are and how difficult this is for this administration. We've got very serious issues on the international scene, and it's hard to reconcile the foreign policy goals with what's happening at home domestically with the economy, inflation, CPI. That's how tough it is right now for this president, Anne-Marie.
Well, that's why the timing of this crisis with Russia couldn't have come at a worse time. The administration is trying to get gasoline prices down. Russia is obviously a key member of the OPEC Plus and one of the biggest exporters of oil and gas in the world. So you have these very precarious, interesting foreign policy moments. Also, the Iranian nuclear deal. If there was an Iranian nuclear deal, you're going to see thousands of barrels of oil hit the market and the price come down. That would help them domestically. So you have two different factions of the White House dealing with different issues, but they will affect Americans and the American consumer. But Jonathan, when it comes to what this administration needs to focus on domestically, because what Americans want to see, that is inflation down. Americans are not going to vote based off what happens in Kiev. They're going to vote based on their grocery bills and based off the price of gasoline.
Nothing about this is easy. Nothing about it. AMH down in Washington. Anne-Marie, thank you. Crude right now, 92.40. WTI at 90.93, Brent at 92.40. At the top of the hour, consumer sentiment numbers here in America. Before we get there, let's get the sector price action. This session has turned out okay for now, at least in the early part. Here's Abby.
It is pretty interesting right now, John. We do have a gain for the S&P 500 in the sector. Action on the day and on the week, very interesting, being driven by rates because, of course, yields are coming in just a little bit today. That is helping out your traditionally rate-sensitive sectors such as utilities, staples, healthcare, and real estate. Those high dividends look a little bit more attractive. Now, financials are higher, too, probably on the big backup on the week. But you were just talking about oil above 90. That's why energy is on top, up 1.4%. Now, on the week, super interesting, as you were mentioning earlier, it doesn't feel like an up week, but the S&P 500 is up about 0.5%. Higher for a third week in a row, the best, longest winning streak since November of last year. Now, this is where the rate action really is taking place. Now, materials, a cyclical sector, that's the top sector on the week. Most sectors this week are actually higher. Banks, not surprisingly, getting a bid, up almost 3%, as that two-year yield you were mentioning is just stunning, up about 25%. 25 bips, I should say, on the week. Now, on bottom, the two worst sectors, utilities and real estate. That's because when those yields go higher like that, those dividends just don't look as attractive. Tech, interestingly, higher.
Abby, thank you. 23 minutes in, equities up, yields backing away at the front end. Just a little, just a little. Coming up, your trading diary, packed full of Fed speak for next week. From New York, this is Bloomberg. Let's call it 26 minutes into the session this Friday. We're up on a week, up on a session, up a third of 1% as yields back away. That's stocks, bonds look like this, 2s, 10s and 30s. Yields up on a 2-year in a massive way yesterday, up the most since 2009. Through 160 this morning, briefly backing down now by a couple of basis points to 155. That's the price action. Here's your trading diary into the weekend and out into next week. University of Michigan consumer sentiment, top of the hour. ECB President Christine Lagarde speaks Monday. PPI in America Tuesday, retail sales and FOMC minutes on Wednesday. Jobless claims on Thursday and a host of Fed speak through the week. Evans, Brainerd, Bullard, Mester. Take your pick. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.